Listen carefully. What I am about to discuss is not a prediction based on a chart pattern, a headline, or a temporary market trend. It is something much deeper than that. It is a possibility that sits beneath the surface of the global financial system, quietly building while most investors remain focused on day-to-day price movements. When people hear a number like 50,000 associated with silver, the immediate reaction is disbelief. It sounds impossible. It sounds disconnected from reality. But that reaction tells us something important. It reveals how strongly our assumptions are tied to the current system. Most people evaluate future outcomes using present conditions. They assume the monetary framework operating today will continue functioning tomorrow in roughly the same way. They assume debt can continue expanding. They assume confidence can continue holding. They assume policymakers will always find a solution. History suggests otherwise. Every major financial era creates the impression that its system is permanent. Every generation believes the structures surrounding them are stronger than they really are. Yet over time, pressure accumulates. Imbalances grow, obligations increase, the cost of maintaining stability rises. Eventually, a point arrives when preserving the existing structure becomes more difficult than changing it. That is where the conversation becomes serious. You need to understand what investors like Ray Dalio have spent decades studying. Long-term debt cycles do not operate in straight lines. They develop slowly, often over many years. During the early stages, borrowing stimulates growth. Asset prices rise. Confidence expands. The system appears healthy, but as debt grows faster than productive output, the foundation becomes increasingly fragile. More borrowing is required to generate the same economic effect. More intervention is needed to maintain stability. More liquidity is required to prevent disruption. At first, these adjustments seem manageable. Then they become permanent. Eventually, they become unavoidable. This is the stage that deserves attention. Around the world, governments continue carrying debt burdens that would have been considered extraordinary in previous generations. Fiscal deficits remain elevated. Central banks face difficult choices. Growth is slowing in some regions while obligations continue increasing. None of these developments individually create a crisis. The danger emerges when they begin reinforcing one another. A heavily indebted system depends on low financing costs. Low financing costs encourage additional borrowing. Additional borrowing increases future obligations. Future obligations create pressure for more intervention. The cycle feeds itself. And while that process unfolds, most investors continue focusing on the surface. They watch daily market fluctuations, they watch quarterly earnings, they watch short-term economic reports. But structural shifts rarely announce themselves through obvious signals at the beginning. They emerge quietly, they develop beneath the headlines. By the time they become visible to everyone, the repricing process is already underway. This is why silver deserves attention, not because it is fashionable. Not because it is guaranteed to rise, not because somebody issued an exciting forecast. Silver matters because of what it represents during periods of monetary uncertainty. Unlike financial assets that depend on counterparties, policies, and institutional confidence, silver exists independently. It does not require a promise. It does not require a balance sheet. It does not depend on political approval. Its value is ultimately tied to scarcity, utility, and recognition. That distinction becomes increasingly important during periods when confidence in traditional systems begins to weaken. Most investors underestimate how rapidly perception can change. For years, an asset can be ignored. For years, it can appear stagnant. For years, it can frustrate holders. Then conditions change, the narrative shifts. What was once overlooked becomes desirable. What was once dismissed becomes important. And what was once considered unnecessary suddenly becomes essential. History has demonstrated this pattern repeatedly. The transition never feels obvious at the beginning. In fact, it often feels uncomfortable. That discomfort is precisely why so many people miss it. They expect major changes to arrive with certainty and clarity. Reality works differently. Uncertainty appears first. Recognition comes later. The crowd responds last. The real question is not whether silver can experience significant appreciation. The real question is what happens if confidence in monetary management continues to deteriorate over the coming years. What happens if debt expansion remains the primary solution? What happens if currency purchasing power continues facing pressure? What happens if investors begin prioritizing preservation rather than speculation? Those questions matter far more than any short-term price target, because once capital begins searching for protection instead of performance, priorities change. Investors start looking for durability. They start looking for scarcity. They start looking for assets outside the traditional framework. That is where silver enters the discussion in a completely different way, not as a commodity, not as a trade, but as a form of financial insurance. And insurance is usually ignored until the risk comes visible. By then, conditions are no longer favorable. By then, the easy opportunities have disappeared. By then, the market has already begun adjusting. This is why understanding the larger picture matters. The issue is not today's silver price. The issue is the environment developing around it. Because if the current trajectory of debt, deficits, monetary expansion, and policy intervention continues, investors may eventually be forced to reevaluate assumptions that have guided markets for decades. When that reevaluation begins, assets that were once considered secondary can move into the center of attention. And when attention shifts toward a relatively small market, the effects can become far larger than most people currently imagine. That possibility is what serious investors are watching, not because they know exactly when it will happen, but because they understand what conditions tend to produce major financial transitions. And right now, those conditions are becoming increasingly difficult to ignore. Now, I want you to think about something that most market participants never stop to consider. Every financial system operates on confidence. Confidence in governments, confidence in banks, confidence in currencies. Confidence in the belief that future obligations can be honored. As long as that confidence remains intact, the system functions smoothly. Transactions occur normally. Credit expands. Capital flows efficiently. Economic activity continues. But confidence is unlike most assets. It cannot be printed. It cannot be legislated. It cannot be manufactured on demand. It must be earned and maintained. And once it begins to weaken, restoring it becomes increasingly difficult. This is why long-term debt cycles matter. The issue is not simply the existence of debt. Debt can be productive when it finances innovation, infrastructure, and economic expansion. The problem emerges when debt grows faster than the underlying capacity to support it. Eventually, the burden becomes too large, servicing costs increase, growth slows, policy flexibility shrinks. Authorities become increasingly dependent on intervention. The entire system starts requiring continuous support. When that stage arrives, markets become extraordinarily sensitive. Small disruptions create larger consequences. Minor problems reveal deeper vulnerabilities. Investors begin paying closer attention to risks they previously ignored. This is where monetary history becomes extremely important. Throughout history, heavily indebted systems have often faced the same challenge. They must choose between allowing painful adjustment or reducing the real burden of obligations through currency depreciation. Neither option is comfortable. Neither option is politically attractive, but one is usually considered easier than the other. And that reality changes everything, because when purchasing power erodes gradually over time, many people fail to recognize what is happening. They see prices rising, they see asset values increasing, they see nominal gains. What they often miss is the changing value of the measuring unit itself. Imagine measuring distance with a ruler that changes length every year. The numbers would become increasingly misleading. The same principle applies to money. If the measuring unit weakens, nominal asset prices can rise dramatically, even if the underlying asset has not fundamentally changed. This concept is critical, because when investors discuss extraordinary silver scenarios, they often focus exclusively on the asset itself. The deeper question concerns the currency being used to measure it. If confidence in that currency declines over time, the resulting repricing can appear extreme. But the apparent extremity may reflect monetary weakness rather than asset excess. Most people struggle with this idea because they think linearly. They assume tomorrow will resemble today. They assume gradual change. They assume familiar patterns will continue. Yet major financial transitions rarely unfold in a straight line. They occur through phases. At first, only a small group notices the underlying pressures. Then awareness begins expanding. Then larger pools of capital start paying attention. Then momentum develops. Finally, broad public recognition arrives. By that point, the majority is responding rather than preparing. That distinction matters. Preparation occurs before consensus. Reaction occurs after consensus. The difference between those two positions can be enormous. This is particularly true in silver. Compared to global stocks, bonds, and currency markets, silver remains relatively small. That means it does not require universal participation to experience substantial repricing. It only requires enough capital to alter the balance between supply and demand. And that balance can change surprisingly quickly. Consider the scale of global financial assets. Trillions upon trillions of dollars are allocated across equities, sovereign debt, corporate bonds, derivatives, and cash equivalents. If even a modest fraction of that capital begins seeking alternative stores of value, the consequences can be significant, especially for markets with limited capacity. This is not an emotional argument. It is a structural observation. Small markets respond differently than large markets. When demand exceeds available supply, adjustments become more dramatic, discovery accelerates, volatility increases. Traditional expectations stop working. Many investors assume they will have plenty of time to respond. They believe warning signs will be obvious. They expect headlines to provide clarity. But major transitions rarely offer that luxury. The earliest stages often appear confusing. Signals conflict with one another. Narratives compete for attention. Uncertainty dominates. That uncertainty causes hesitation, and hesitation causes delay. Meanwhile, structural forces continue operating beneath the surface. Debt continues expanding. Monetary pressures continue building. Fiscal challenges continue accumulating. Purchasing power continues facing erosion. These developments do not disappear simply because markets temporarily ignore them. They continue advancing quickly, persistently, relentlessly. That is why long-term investors focus on conditions rather than headlines. Headlines describe events after they occur. Conditions reveal what may be forming beforehand. Right now, the conditions deserve attention, not panic, not blind optimism, attention. Because when multiple structural pressures begin converging simultaneously, outcomes that once seemed improbable become increasingly plausible. This does not mean every dramatic forecast will occur. It does not mean every prediction will prove accurate. What it means is that investors should be careful about dismissing possibilities solely because they appear extreme under current assumptions. Current assumptions are not permanent. Economic environments change. Monetary regimes evolve. Market leadership rotates. Perceptions shift. And when perceptions shift, capital follows. That movement of capital is often the defining feature of major transitions. The crowd notices after the movement becomes visible. Experienced investors study the conditions that precede it. That is the difference. One approach focuses on confirmation. The other focuses on preparation as we move forward. The most important question is not whether silver will experience volatility. Volatility is inevitable. The more important question is whether the underlying forces driving interest toward tangible assets are strengthening or weakening. Because if those forces continue strengthening, the conversation surrounding silver may look very different in the years ahead than it does today. And that is exactly why some of the smartest macro investors continue paying close attention while most people remain focused elsewhere. Listen carefully. The biggest mistake investors make during periods of financial transition is assuming that the future will unfold according to the same rules that governed the past decade. That assumption feels safe, it feels logical, it feels comfortable. But comfort has a way of blinding people to change. Most investors have spent years operating in an environment where financial assets benefited from abundant liquidity, policy support, and relatively stable confidence in institutions. During that period, traditional investment strategies appeared reliable. Market participants learned to buy weakness, trust intervention, and assume stability would eventually return. But every cycle creates habits. And sometimes those habits become liabilities. The reason Ray Dalio's broader warnings attract attention is not because they focus on short-term market predictions. It is because they focus on the architecture beneath the market. Architecture matters. A building can appear stable long before structural weaknesses become visible. The same principle applies to financial systems. A currency can appear strong while purchasing power slowly erodes. A market can appear healthy while leverage quietly expands. An economy can appear resilient while underlying vulnerabilities continue accumulating. Survey appearances rarely tell the entire story. That is why serious investors spend less time focusing on daily noise and more time examining long-term trends. And several long-term trends deserve attention right now. Global debt remains historically elevated. Fiscal pressures continue mounting. Demographic challenges are emerging in many developed economies. Interest costs are consuming larger portions of government budgets. Monetary authorities are increasingly constrained by competing objectives. None of these factors guarantee a specific outcome, but together they create a landscape where confidence becomes increasingly important, because confidence is what holds complex systems together. When confidence is strong, investors tolerate risk. When confidence weakens, priorities change. Protection begins replacing speculation. Durability begins replacing growth. Preservation begins replacing expansion. This shift does not happen all at once. It develops gradually. Then suddenly it becomes visible. That is how most major transitions unfold. For years, very little appears different. Then the pace accelerates. The public notices. The media reacts. Analysts revise expectations. Institutions adjust allocations, and capital begins moving toward areas that previously received little attention. This is where silver becomes especially interesting, not because it is guaranteed to outperform every asset, not because dramatic forecasts automatically become reality, but because silver occupies a unique position. It is both an industrial metal and a monetary asset. It participates in technological demand while also serving as a store of value during periods of uncertainty. That combination gives it characteristics that few assets possess. When industrial demand increases, silver benefits. When monetary concerns increase, silver can benefit as well. And if both forces strengthen simultaneously, the dynamics become even more powerful. Many investors underestimate how quickly sentiment can change once recognition begins. They assume adoption occurs slowly. They assume capital flows remain orderly. They assume markets always provide ample opportunity. History suggests otherwise. When confidence shifts, reactions often occur faster than expected. Investors who previously ignored an asset begin seeking exposure. Institutions that previously allocated nothing begin allocating something. Analysts who previously dismissed a thesis begin reconsidering it. That collective change creates momentum, and momentum can produce outcomes that appear surprising to those who were not paying attention beforehand. This is why preparation matters. Preparation is not about predicting exact dates. It is not about guaranteeing specific prices. It is about recognizing structural conditions before they become obvious. The crowd usually arrives after validation. The opportunity often exists before validation. That principle has repeated throughout financial history. The challenge is psychological. Most people feel more comfortable acting when everyone agrees, but consensus often arrives after the largest gains have already occurred. That is why conviction becomes important, not blind conviction. Informed conviction, conviction based on studying history, conviction based on understanding incentives, conviction based on recognizing structural pressures. When you examine the current environment through that lens, several realities become difficult to ignore. Debt continues expanding. Currency purchasing power remains under pressure. Policy of flexibility appears increasingly limited. Confidence is being tested from multiple directions. Those conditions do not guarantee immediate change, but they do create the foundation for future change. And foundations matter more than headlines. Headlines capture attention. Foundations determine outcomes. The investors who understand that distinction are often the ones who position themselves before broader recognition occurs. Everyone else waits. They wait for certainty. They wait for confirmation. They wait for reassurance. Unfortunately, reassurance tends to arrive after the transition is already underway. By then, prices have adjusted, narratives have shifted, opportunities have narrowed. That is why awareness matters today, not tomorrow, not after a major move, not after consensus forms today, because the purpose of understanding macroeconomic trends is not to react to the future, it is to prepare for it. And if the structural pressures currently developing continue intensifying, the years ahead could look very different from the years behind us. The real question is not whether change will occur. Change is inevitable. The real question is whether you recognize the signs before they become obvious to everyone else. Because once everyone sees the same thing, the advantage disappears. That has always been true in markets, and it remains true today.